The backtest for the Aegis Dual Regime Protocol, version 6.0, presents an impressive quantitative profile. It claims a 27.4% compound annual growth rate, while capping downside exposure at a 4.1% maximum drawdown. The model operates as a dual momentum trend-following system. It uses specific macroeconomic regime overlays to manage capital allocation across different market environments. These metrics rely on synthetic compounding and zero-friction execution. The results are a product of simulation parameters that do not account for the costs of live trading. Deploying institutional size against this architecture creates an immediate performance gap. The logic of the backtest lacks the physics required to handle the slippage and market impact of real-world orders. We are going to deconstruct the system to isolate its failure points. By identifying where the logic breaks under stress, we can apply the technical patches used by institutional desks. Quantitative architects focus on how a system behaves under duress. The goal is to determine how a model reacts when subjected to the actual stressors of a live market tape. The state machine begins with the macro gatekeepers. A risk-on posture is triggered only when both the cap-weighted SPY and the equal-weighted RSP trade above their 200-day simple moving average. If either breaks below that level, the system shifts to risk-off. A volatility override sits at the top of this logic. A VIX reading above 30 instantly forces the system into a 100% defensive cash posture, bypassing the moving average signals entirely. The asset universe is divided into two execution paths. Track 1 rotates through 11 JIGS sector ETFs for growth, while Track 2 utilizes defensive assets like gold and treasuries. Asset selection is driven by a vector scoring formula. It weights 12-month and 3-month momentum against 90-day volatility to identify assets with the most persistent upward trajectories. The execution layer uses inverse volatility sizing to determine position weights. Risk is managed through an intraday 3 ADR chandelier trailing stop designed to exit positions as volatility expands against the trend. While the mathematical framework is consistent, it operates within a frictionless environment that ignores the mechanics of the institutional tape. The first major vulnerability is the assumption that an intraday stop-loss provides a hard floor for capital. In a live market, a 3 ATR stop often functions more like a trapdoor. Consider an ETF closing at $100, with a stop-loss set at $90. In a simulated environment, the math suggests this will limit your loss to exactly 10%. But systemic shocks often occur overnight. If the market gaps down and opens at $85 the next morning, the price has bypassed your $90 safety limit entirely. The $90 stop becomes a market order the instant the exchange opens. Because of the liquidity vacuum at the open, you are filled at the current bid of $85. A theoretical 10% loss has just become a 15% reality. High-frequency trading algorithms actively hunt these intraday levels. Liquidity sweeps at the opening bell are designed to trigger retail stop orders before the market finds its equilibrium for the day. This structural flaw extends to the 3:45 p.m. manual check for mutual funds. The model assumes that checking an ETF proxy 15 minutes before the close is sufficient to manage risk. This ignores the market-on-close imbalances. Massive institutional block trades hit the tape at 3:50 p.m., often causing price moves that render a 3:45 check obsolete before the fund can even be sold. To patch this, we must remove intraday GTC stops. Institutional risk is managed by shifting to end-of-day closing stops. Intraday volatility is noise. Risk is sized based on ATR during the day, but exits are executed strictly based on closing prices to avoid being stopped out by temporary liquidity gaps. The second vulnerability involves curve-fitting historical data to define macroeconomic regimes. The static VIX threshold of 30 is a rigid rule that fails to adapt to different market environments. This chart of the March 2020 crash shows the specific type of event the rule is optimized for: a sudden vertical spike in volatility that triggers a clear exit signal. Contrast that with this split-screen view of 2022. During a slow bleed bear market, the VIX can stay below 30 for months. The S&P 500 can drop 25% while the circuit breaker never triggers, leaving you exposed to a grinding decline. The patch is a dynamic volatility overlay. By triggering risk off when the VIX moves 2 standard deviations above its 60-day average, the model adapts to the current volatility environment. We also see risk in the equal weight breadth requirement. In markets driven by a few dominant tech giants, the broader market often lags. A rigid breadth rule will park you in cash while the indices continue to climb. Hard-coded macro parameters are often artifacts of past cycles. Systems require relative dynamic thresholds to maintain sensitivity to shifting volatility regimes. The model attempts to force diversification by requiring that top assets maintain a Pearson correlation below 0.75. This math breaks during major regime shifts. When a new bull market begins, capital flows into all sectors at once, and all correlations approach 1.0. Demanding low correlation in this environment forces the model out of high-momentum leaders. It is effectively forced to buy lagging, low-quality sectors just to satisfy a statistical constraint. The trajectory rule adds further lag. Requiring a positive slope on a 200-day moving average ensures the model misses the start of a new cycle, as moving averages can take months to reflect a change in direction. We replace these math limits with cluster diversification. By grouping sectors into cyclical, defensive, and growth categories, we ensure economic variety without relying on fragile, backward-looking correlation math. Organic diversification is more robust than statistical limits. It avoids trading away early cycle returns for the sake of a correlation coefficient. The final vulnerability is tax drag. This is the friction that often determines whether a model is actually profitable in a taxable account. Track 1 rotates assets up to 8 times a year. This frequency ensures that nearly all gains are taxed at short-term capital gains rates. This diagram shows the impact. A 27.4% gross return is slashed to roughly 16% net after taxes. Over 20 years, this friction radically alters the compounding curve, leaving you with a fraction of the simulated total. We apply a tax lot hysteresis patch. If an asset is within 60 days of qualifying for long-term tax treatment, the momentum hurdle required to trigger a sale is mathematically doubled to justify the tax hit. Factoring in compounding friction is essential for live modeling. Without it, a backtest is simply promising capital that the tax code will never allow you to keep. In its baseline state, ADR P 6.0 functions as a highly optimized historical simulation. It assumes a vacuum of infinite liquidity and zero taxes, conditions that do not exist on an institutional trading desk. Live deployment faces immediate risk from the gap-down liquidity vacuum. Systemic shocks can cause assets to open well below simulated stops, neutralizing the model's downside protection at the opening bell. The core engine of dual regime logic and inverse volatility sizing should be retained. These elements provide a structurally sound foundation for our trading system. However, the machine must be finalized with the EOD execution patch, dynamic volatility scaling, cluster diversification, and tax lot hysteresis. Only when execution friction is fully modeled and microstructure leaks are plugged does a theoretical backtest transform into a live-ready quantitative machine.